Well, let's go to Sydney now, and Kumar Palghat, co-founder and head of portfolio management at Kapstream Capital, joins us this morning. Good to have you on the program, Kumar. What are you doing in these uncertain times?
Well, if you think of where the equity markets are and where debt markets are, I mean, the debt markets in the U.S. are saying things are going to get really bad. I mean, 10-year treasuries are at historical lows, and European credit markets are extremely wide, so they're saying there's a high probability there's going to be a default. Whereas equities, from the peak, Europe's down about 60%, and the U.S. is down about 15 or 20%. So the market's telling you the problems really are in Europe. So what should an investor do, which is your question? I think go ahead.
Go ahead, Kumar, because I was looking at your cash holdings. You've increased it 25%. So to me, you sound very cautious. Is that what you're advising investors to do? Hold more cash right now?
I think in periods of uncertainty, you sort of have to be ahead of the market. You're right, my fund has about 25% cash. I wish I had 30 or 40% cash. But there are some good opportunities that are available to investors, and the shining light in all of this is the Asian region continues to do well. I think they have good reserves, as you were mentioning earlier in your show. Their currencies continue to be strong. The central banks had raised rates for quite a while in Asia. They stopped because of the global crisis. And I continue to think that with a younger population, more reserves, good fiscal policy, I think you're going to get a great chance to buy some assets in Asia, whether it's equities, bonds, or currencies.
Okay, you say you're bullish on Asian currencies. We had this intervention to to strengthen the currencies in South Korea, in Indonesia, in India. What are your best bets in the Asian currency space right now?
So we have a fund that has exposure to 10 different currencies in Asia against the U.S. dollars across 10 different investment-grade countries. We think that over time, the only way for the U.S. to continue its policies is to weaken the U.S. dollar. The Fed's not going to change interest rates anytime soon. So we think it's a secular trend that the Asian currencies will continue to strengthen. What you've seen lately is when risk assets are off, then people sell Asian currencies as well. They sell Asian equities, they sell Asian bonds, but I think they're selling purely to shore up some capital, and I think for investors that have cash, it's a great time to buy some of these currencies because I think the trend is up.
All right. It seems that way, doesn't it? Okay. Now, Kumar, let's talk about the equity in the equity space. So where are you looking these days? Where are you advising people to buy up?
We think that the equity market has still got some ways to go in the sense that the equity markets will go down a lot more because, as you mentioned, equities are reacting to short-term news, whether it's news that China is going to buy Italian bonds or whether the German and French governments say that Greece is not going to default. These are just a piece of information that are coming to the market. They're not really fundamentally driven information. They're not economic data. They're not job creations. They're not, numbers coming out that would say the economies are doing well. So in our view, equity markets from here have another 10 or 15%, maybe more, to fall before we think there's value in equities. But we're purely a bond fund manager in Asia.
Okay, well, that's kind of scary. 10 or 15% or more downside. How interesting. What about the European sovereign debt crisis? We had a downgrade of some of these banking shares, and there's concerns about a full-blown banking crisis. I mean, how bad are things going to get from the European side?
Well, it's already gotten bad in a way because if you think about where some of these banks in Europe are carrying the sovereign debt that are issued by Greece or Portugal or Italy, I think they're still carrying them at levels that are quite high. So if they mark to market those assets down to where they're actually trading, then the banks need a lot more capital. So think of this similar to GFC, except it's a slow train that's coming. And this time, it's the subprime is the government. So the banks are going to eventually need to get more capital. So it's not over yet.
Well, it's not over yet, but what about this news that China might be buying into Italian bonds? I talked to a few investors. Some are skeptical, some are not. Your stance right now on this news story?
I think countries in Asia that have large amount of reserves, which is China as well, will eventually, invest their money in markets in Europe that will put a bottom to the yields on European bonds. But I think it's going to be slow in coming because they're going to have to believe that the economies in Europe will improve. Otherwise, if you're a central banker in China and you're sitting on the reserves, you're not going to buy Greece bonds here if you think they're going to default. And the market's telling you that the probability of default is almost 80% over 5 years. So I think it's going to be cautious, and I think it's not going to come flooding in anytime soon.
Okay, Kumar, thank you for sharing your insights. It's great talking to you this morning. Kumar Palghat of Kapstream Capital joining us from Sydney.